So
Yes.
let's talk about tapering first and what tapering is, what it means. I don't think a lot of people understand the mechanics of tapering and how it impacts anything in the market.
Right.
So let's start with that.
Yeah. So logically, before the Fed hikes interest rates, they're going to start the process of tapering. This is the same process they went through in 2018 time period, which basically, as a reminder, the Fed right now, every month, is purchasing approximately $120 billion worth of treasuries and mortgage-backed securities. And when you taper that, you reduce the amount of monthly purchases at a steady rate. So you're still growing the balance sheet. The Fed will still be buying assets, but doing so at a slower and slower rate until they're buying nothing every month. They're just reinvesting maturing principal payments on their balance sheet.
Right here, we're showing sort of where we sit
Fed
today
assets, yeah.
and where we're projected to head to, right?
Yeah.
And this is assuming a tapering of?
So this assumes what is starting to become consensus, which is the Fed will start tapering the pace of asset purchases next calendar year, tapering $15 billion at each of the 8 FOMC meetings throughout the year. Meaning you would go from $120 billion in monthly purchases in January down to 0 by the end of 2022. That has become consensus. So that's what that green line represents.
So we would end up somewhere with the Fed balance sheet around just under 10 trillion.
That's right. We would go from 7.9 trillion to 9.6 trillion, which that change is generally viewed right now as sort of hawkish, as not very supportive of monetary conditions, because this is in essence starting to take the punch bowl away. But in the act of taking the punch bowl away, the Fed would be adding $1.7 trillion to their balance sheet, which is the exact same size as quantitative easing 3, which at its time, which was 2013, 2014 time period, was the largest monetary stimulus experiment we'd ever seen.
Right.
So that's what taking the punch bowl away looks like in a post-COVID world, apparently.
And so let's say they can't taper.
Yeah.
Where does this line end up?
It would keep going up sort of in a linear fashion at 120 billion per month. And that's a real possibility. This is what they're doing. They're taking the market's temperature. So Jerome Powell said, you can think of this meeting we just had as the talking about tapering meeting. Let's throw that out to the market and see how they react. And they took it in stride, which means now the Fed needs to take the next step, which is actually talking about tapering.
Right.
They'll see how the market reacts to that. Then if all goes well there, they'll take the next step, which is actually announcing the taper. And if that goes well, they might start the first leg of the taper, which would be at the January FOMC meeting, January 2022, and they would announce they're going to reduce the pace of monthly asset purchases from 120 billion to 105 billion per month. And then we'll see how the market takes it, right? So, it wasn't at this press conference, but at past press conferences, Jerome Powell's been quoted as saying, sort of like we're walking around with the lights off. You want to move very slowly with your arms out ahead of you so you don't hit anything. Which once again portrays a tremendous amount of confidence. But that goes to show this will be a slow, methodical process, at each point pausing to take the market's temperature.
You just don't want to trip over $9.6 trillion, because that would hurt.
And exactly. And also, 9.6, you have to put that into context. That's approaching half of GDP. Half of GDP.
Yeah.
So nowhere close to Japan, but we're also a much larger economy than Japan. But that's a huge number.
And so maybe for the viewers, just explain what tapering does to the economic system and to the financial markets.
Yeah. So the reason why the Fed would have to buy assets is because something like COVID-19 happens. Interest rates are already at 0. Everyone's wondering, does the Fed have any more ammunition? And they do. They invented it in the global financial crisis. They can start doing outright asset purchases. They're just going to start buying longer-term treasuries, agency mortgage-backed securities, et cetera. On a very high level, what this does is it eases financial conditions. And what does that mean? That means interest rates, especially on corporate bonds, treasury bonds, they go lower, which makes it much easier for companies and governments, very importantly, to refinance and roll over their debt, prevent things like bankruptcies. Credit spreads get much tighter. The dollar generally gets weaker. All of these things make financial conditions for everyday businesses, corporations, et cetera, easier so they can make it through any difficult time period like COVID. We're certainly not in a COVID market environment anymore. Also, asset purchases provide stability to financial markets. It helps financial markets function properly, which apparently means they should be going up all the time because that's when this happens.
That's the new normal.
Right. So it does all of those things.
The question we get is, why does the taper matter? Why doesn't it matter?
And so the answer to that is the taper will matter until the Fed reverses course. So it sort of matters until it doesn't, which is a bad answer. But basically what we mean by that is we talked about how the Fed is going to take this very slowly and methodically. They know Ben Bernanke had a taper tantrum. They don't want to repeat that. They don't want to do anything to mess with the economic recovery. And they don't want anything to disrupt what's going on in this chart, which is the blue line is corporate debt to GDP. It's above 50%. We don't typically get to over 50% corporate debt to GDP. That's a lot of debt.
A lot of debt.
And the only real reason why we can have over 50% debt to GDP is because of the green line. So the cost of that debt, or the interest rate on corporate bonds, is near all-time lows. If corporate bond yields were to rise, say they were to double or triple, a lot of companies on the margin would not be able to afford their debt loads. And you would have the credit cycle reset. That would mean very bad things for the economic recovery. So the Fed knows this. They are in a very difficult position. It's a high wire act. If this is how we think it'll likely play out, they will taper for as long as the market will let them. And then they will stop because they have to.
Right.
Because there's no way you can achieve price stability and full employment if the credit cycle is turning over.
Because what happens when the credit cycle turns over?
Well, you would get an economic recession,
bankruptcies,
layoffs, so on and so forth. Deflation,
deflation,
all of those bad things. So that's our general view. The Fed will taper for as long as the market allows it, and then they will stop. You recall the last time they tapered, it worked.
Yep.
They got through the taper. There was some volatility for sure. Then they had to maintain the size of their balance sheet for about 3 years.
Right.
And then they actually tried shrinking it. And that lasted about 4 months.
Yeah, it didn't go so well.
And then they had to reverse course. And because market volatility picked up, and they're ultimately listening to markets. So.
And at what point, I mean, that was a third or over a half of where we are today?
Yeah.
So at what point does the ability for them to reverse course just become not an option?
Well, I mean, you could ask Japan about that. It's exactly right. It isn't really an option at this point. Yeah. You would have to see over this time period corporations deleveraging their balance sheets to the point where they could take on higher borrowing rates and still be fine. And so that's not our base case for sure.
And maybe a follow-on question. What does the tapering effect on rates do to the fiscal situation we're in?
Great point. So we're talking about the corporate bond market, which tapering purchases of treasuries would indirectly impact corporate bond yields, but it would more directly impact treasury yields. And somebody needs to buy the debt, right? So we talked about how banks can't expand their balance sheets because they're subject to things like supplementary leverage ratios. Well, treasuries also count against your supplementary leverage ratio calculation, unfortunately. So banks are somewhat limited in how many treasuries they can buy. And so there really are only a few buyers of treasuries. I mean, they're very large, but you have the Fed, You have the big money center banks in the U.S., the Fed member banks, which have to, at auction, buy treasuries.
Primary dealers. Yep.
They're the primary dealers. And then you basically have foreigners. And foreigners, they're fair weather buyers.
Correct.
If the yields are attractive and they think the dollar's going to be stable, they'll nibble at it. But they're way less of a player than they were before. The banks are limited. They have these balance sheet restrictions put on them by governing bodies that say they can't take down that much. This was a problem in 2019. They ran into capacity issues, and the Fed had to come in and buy again. And then you have the Fed, and they're trying to say, no, we're going to do less of that. So this is all happening. You're wondering who the buyer is going to be at the same time when obviously we're going to have record new Treasury issuance because we know what the deficit situation looks like. So the Fed can talk a big game, and they can talk like an adult, but ultimately they're going to have to buy. They're going for the foreseeable future, they are going to have to be a large purchaser of treasuries as long as U.S. monetary policy functions in the way it does, where the primary dealer banks have to take this on temporarily. The Fed will have to help them out by taking those treasuries off their balance sheets so they don't run into things like capital charges and things like that. So there's no going back.
Yeah, there's no going back. Yeah. Well, we'll leave it there. It's great to be back. It's great to be here with Mike and to be with all of you. So we'll look forward to our next video. And till then, if you have any questions, let us know.